everyone. Welcome back to the course on International Financial Management. Over the past three lectures, we have built a strong theoretical foundation for understanding exchange rates. We began with purchasing power parity, moved to Fisher effect, and the international Fisher effect. And in the last lecture, we explored the interest rate parity. All the three of these parity theories are powerful, but they primarily explain exchange rates through prices, inflation, and interest rates. They are, in sense, the economist view of currency market. But the real world is richer and more complex than any single framework can capture. Exchange rates are also moved by forces that go beyond prices and interest rates. And in today's lecture, we will explore various forces that shape up the different theories of exchange rate determination. Let's begin. In the real world, exchange rates are also driven by forces that go beyond prices and interest rates. They are given by the income level of countries and their effect on demand for imports. They are driven by the portfolio decisions of global investors who are constantly reallocating capital across countries in search of the best risk adjusted returns. Beyond income levels and portfolio decisions, exchange rates are also shaped by the stickiness of prices in the short run, the fact that prices of goods do not adjust instantly to news or information, which causes exchange rates to overshoot dramatically before settling. Further, the role of market expectations and sentiments, where what traders and investors believe will happen, can move exchange rates just as powerful as what is actually happening. These forces are captured by a separate set of theories. They are the income effect theory, the portfolio balance theory, the sticky price model, overshooting model, and the market expectations theory. Let us now explore each one of them. The income effect theory focuses on how changes in national income drive exchange rates through their effect on import demand. The logic is straightforward. When a country's national income rises, that is, when the GDP grows, employment is high, and consumer and businesses have good amount of money, they naturally spend more. And part of that increased spending goes towards imported goods. A growing India buys more American electronics, more German machinery, more Japanese automobiles. This increased demand for imports means increased demand for foreign currencies that are dollars, euros, yen, or it can be others also to pay for those imports. An increased demand for foreign currency with supply remaining constant means the foreign currency appreciates and domestic currency depreciates. Let us make this concrete with the help of an example of India. Suppose income of Indian citizens increases, Indian consumers would like to purchase goods, smartphones, electronics, machinery, luxury goods. The demand for dollars, euros, and yen rises sharply. The demand for foreign currency in the foreign exchange market increases as Indian importers buy these foreign currencies. The foreign currency appreciates, and as a result, rupee is going to depreciate. Now consider the reverse. If India's trading partners, say the USA or the EU, experience strong income growth, they will demand more of India's exports like software services, textiles, pharmaceuticals. This increased demand for Indian goods requires foreign buyers to buy rupees. Demand for rupees rises, the rupee appreciate. The key insight here is that a country that grows faster than its trading partner will tend to see its currency come under depreciation pressure because its import growth outpaces its export growth, unless a country can grow its export at the same pace as its import. This is a counterintuitive but very important real world observation. Our second theory is the portfolio balance theory, and this one explains the dramatic, sometimes sudden exchange rate movements or changes. Modern investor, whether it's a pension fund or insurance companies or sovereign wealth funds, hedge funds, or it can be individual investors, they hold portfolios of assets spread across multiple countries. These portfolios include domestic bonds, foreign bonds, equity, and many other financial asset classes. At any given moment, investors are continuously evaluating the risk return profile of assets in different countries and making decisions about where to allocate their capital. When the expected return on assets in one country changes, perhaps because interest rates rise, or because the economy looks stronger, or because political risk falls, investors rebalance their portfolio. They shift capital from lower return assets to higher return assets, from higher risk assets to lower risk assets. And when this rebalancing involves moving capital across borders, it creates large cross border capital flows, and that directly affects exchange rates. The example in which in this slide captures this perfectly. Suppose US bond becomes more attractive, perhaps because the Federal Reserve raises interest rates, making US bonds offer a higher yield. Global investors now want to hold more US bonds in their portfolio. To buy US bonds, they need dollars. So they sell their domestic currencies, that is rupee, euro, yen, and buy dollars. This surge in demand for dollars causes the dollar to appreciate. Conversely, if confidence in a country's economy or assets fail, perhaps due to a political crisis, a debt problem, or simply a loss of investor sentiment, capital flows out rapidly. Investors sell assets in that country, converting back to their home currencies. The currency of the affected country depreciates, sometimes sharply and suddenly. Our third theory is the sticky price model, also known as the overshooting model. It is one of the most elegant and influential ideas in all of international finance, and it explains something that has always puzzled observers of currency markets. Why do exchange rates move so dramatically in the short run, often far beyond what economic fundamentals would justify? The answer lies in the fundamental asymmetry between two types of markets. One is the goods market, where prices are set by businesses and are slow to adjust. If the Reserve Bank of India increases the money supply today, owners do not immediately raise their prices. Wages, rents, and products prices are sticky. They adjust gradually over months and quarters. This is a well established reality of how goods market work. Financial market, on another hand, are the opposite. Currency traders, bond investors, and capital flows react to new information almost instantaneously. The foreign exchange market processes new information in seconds. Now think about what happens when these two speeds collide. Suppose the RBI unexpectedly expands the money supply. In long run, we know from PPP that this should lead to a proportional rise in prices and a proportional depreciation of a rupee. This is called long run equilibrium. But in short run, prices have not moved, they're sticky. While the financial market, which adjusts instantly, is instrumental in bringing change in exchange rate alone. Thus, in short run, rupee falls by far more than the long run amount. Then slowly, over the following months, goods prices begin to rise as PPP predicts. As they do, the excess depreciation of the rupee is no longer justified. The rupee gradually appreciates back towards its true long run equilibrium. So the exchange rate first overshoots dramatically, then corrects back. This is why we see such sharp, violent currency movement in the short run, followed by gradual reversals. It is not irrational panic, it is the logic and mathematically predictable consequences of sticky prices meeting instant adjusting financial markets. The model is profoundly important because it reconciles two seemingly contradictory observations. PPP holds in the long run, but exchange rates are wildly volatile in the short run. The overshooting model tells us both can be true simultaneously and explains exactly why. Our final theory is the market expectation theory. And in many ways, it is the most modern and the most relevant to understanding the exchange rate behavior we see on daily basis. All the theories we have studied so far, whether it is PPP, income effects, portfolio balance, overshooting, they are ultimately grounded in current or future economic conditions. But the market expectation theory make a subtler and more powerful point. It says that exchange rates are driven not just by what economic conditions actually are, but by what market participants expect them to be. Let us think about what this means in practice. Suppose the RBI signals in a press conference that it is considering raising interest rates in the coming months. The actual rate hike has not happened yet, but every currency trader in the world has just received new information and they act on it immediately. They buy rupees in anticipation of the higher returns that the rate hike will eventually deliver. The rupee appreciates right now before a single basis point of interest rate has changed. This is forward looking nature of the currency market. By the time the rate hike actually happens, much of the rupee's appreciation may have already occurred because the market priced it in the moment expectations shifted. Now, expectations are shaped by three forces in particular. The first is speculation. Traders who take position based on their views of where the currency is going in future. When speculators expect a depreciation and act on the expectation by selling the currency, they can actually cause the depreciation they predicted. Expectations become self fulfilling. The second force is market sentiments, the overall mood of global investors. In periods of global uncertainty, a financial crisis, that is, a pandemic, a geopolitical conflict, the investors move towards safe assets and adopt a more cautious approach. They flee emerging market currencies, including the rupee, and move into perceived safe havens like the US dollar or Swiss franc. This happens not because Indian fundamentals have changed, but because sentiments have shifted globally. And the third force is the news or the surprises that the news bring. Any piece of information that was not already priced in, any unexpected inflation reading, a surprise election outcome, a sudden policy change cause an immediate and sharp exchange rate adjustment as the market rapidly reprices its expectations. The key implications of the market expectation theory is this. By the time you read about the economic development in the newspaper, the exchange rate has already reacted. Markets are faster than news. They trade on expectations, not on confirmed facts. And this is why exchange rates can sometimes seem to move for no obvious reason. The reason exists, but it lives in the collective expectations of millions of market participants, not in any published economic statistic. Well, each theory that we have discussed so far illuminates a different dimension of the same fundamental question. What determines the value of one currency relative to another? And together they give us a rich, multifaceted answer. We now move to an important concept that connects exchange rate movements to the real economy known as exchange rate pass through. It aims to identify how changes in exchange rates influence import prices, export prices, and domestic inflation. Let us start with the definition. Exchange rate pass through refers to the extent to which a change in the exchange rate leads to a change in the price of the imported or exported goods when expressed in another currency. There are two broad outcomes. One is complete pass through. The entire change in the exchange rate is reflected in the price of goods, with no part of the change being absorbed by the exporter or importer. And the other is incomplete pass through. Only a portion of the exchange rate change is reflected in the prices, while the remaining part is absorbed at some stage in the supply chain. Now, this concept connects very directly back to PPP, which we studied earlier this week. Exchange rate pass through essentially measures the percentage change in domestic prices resulting from a 1% change in the exchange rate. In simple terms, if the rupee depreciates by 10% against the dollar, does the price of the imported goods in India also rise by 10%? Or does it rise by less? Or perhaps not at all? This question matters enormously for inflation, for monetary policy, and for trade competitiveness. Let us explore it carefully. Now, let us look at the three possible scenarios depending on the degree of pass through with the help of a single unified example. Let us suppose the Indian rupee depreciates by 10% against the dollar. Now, there is case 1. There is full, complete pass through. The full exchange rate change is passed on to the consumer. This is directly linked to PPP. A complete pass through indicates that PPP holds. Prices of tradable goods, when expressed in the same currency, are equal across countries. Let us suppose that the Indian rupee depreciates by 10% against the US dollar again. Now, in case of partial pass through, say around 50%, we observe that import prices in India rise by only 5%, not the full 10%. This indicates incomplete exchange rate pass through, where the exchange rate change is not fully reflected in the domestic prices. The remaining 5% adjustment is absorbed within the supply chain. This absorption can happen through a reduction in the foreign exporters' profit margin or a reduction in the Indian importers' margin. The extent to which each party absorbs the impact depend on factors such as market competition, pricing power, and the desire to maintain market share. Thus, in partial pass through, the burden of exchange rate changes is shared rather than fully passed on to the final consumer. The third scenario is zero pass through, where import prices in India do not change at all despite exchange rate fluctuation. In this case, the entire exchange rate movement is absorbed with the supply chain through adjustments in exporter and or importer profit margins. This situation is extremely rare and is typically observed in highly competitive markets where firms have little to no pricing power and cannot afford to pass on cost changes to the consumer. Now, let us imagine that the importer imports a particular goods or a component. He is going to later on sell it to the consumer. Now, if he is not able to change the price of that particular goods or that particular component because of the price sensitivity, because he feels that the demand is going to reduce, then the whole thing will be absorbed by the importer and cannot be passed to the consumer. So, if there is some depreciation in rupees, the import prices are going to increase, and this particular depreciation he may not be able to pass to the consumer. So, this is known as zero pass through. Now, let me explain you with the numerical. Now, for example, the original import price is rupees 100 and the importer sells at rupees 120. Now, suppose rupee depreciates, and now the import cost rises. Import price rises. Let's say earlier $1 was equal to 100 rupees, and now $1 has become equal to 110 rupees. Fine. So, here 10% of depreciation. Now, this depreciation means that when the importer is going to buy the product, let's say the cost of goods was $1 per unit. Now, when it was just 100 rupees, the importer used to spend 100 rupees, fine, because he is going to pay in dollars. So, when he used to pay in dollar, he used to spend only 100 rupees. But now it has depreciated, the rupees have depreciated to 110 rupees. So, hence he is going to pay 110 rupees for this particular one unit. Now, suppose you know the price, that is the selling price, that is ultimately he is going to sell it to the consumer, the local consumer. The price cannot be changed. So, it is going to remain the same. So, what is going to be the price that he sells to the local consumer? He will sell the same price. This is 120 rupees. Had he increased the price to 130, the profit margin would have been 20 rupees, which would have been the same as before. But since there is it is not possible for him due to competition, he is not able to increase the price. So he is going to sell at the old price to the local consumer, and in this case his profit margin falls to rupees 10. This is the case of zero pass through. Now let us understand complete pass through. Right? So we will be talking about complete pass through. And here we will take the example of the exporter. Now let us say the initial exchange rate is equal to $1 equal to 80 rupees. Now exporter sells 800 rupees worth of goods, and foreign buyer pays $10. Now if domestic currency, appreciates by 10%, the new exchange rate is going to be $1 equal to rupees 72. Now to keep the revenue unchanged for the exporter, so to keep revenue unchanged, the foreign buyer is going to bear the price, and hence the foreign buyer is going to increase the price to $11.11. Now in the complete pass through, what will happen? The exporter is going to get the same money, which is 800 rupees. Why? Because now the price of the product is $11.11, and if we multiply it with the new exchange rate, this comes out to be 800. So the exporter incomes remain same. The exporter was able to fully pass through his loss due to depreciation to the foreign importer. Now let us understand complete pass through from the perspective of the importer. That is, this is also an example of complete pass through, and this is from importer's perspective. Let us say the same example, let us take the same example. The initial exchange rate is equal to rupees 80 per dollar. Now the American exporter charges $10. Now suppose the rupee depreciates by 10%. So hence now the value of $1 becomes 88 rupees. Now Indian importer will have to pay will have to pay 880. Now in this case there can be two things in complete pass through. Either the pass through is passed on to the exporter, that is the American exporter, or it is passed through to the consumer. So let us say that earlier the value of one particular product, that is X, 1 unit of X, used to be 80 rupees, which is before the exchange rate change. Now in complete pass through, it can be passed to the consumer and the 1 unit of X will now become 88 rupees, which is after exchange rate change. So the importer has completely passed his loss to the consumer here, right? The other possibility can be that he is able to pass it to the American exporter, and in that case the American exporter might reduce the cost of the 1 unit of X to $1.909, and with the new exchange rate the payment the importer has to make to the American exporter becomes 800. So most likely it happens that the loss due to depreciation is passed on to the consumer in case of import. Now let us understand a scenario of partial pass through. Let us understand partial pass through. Now let us say we have a US importer and we have a UK exporter. The US importer is importing razor from UK exporter and is paying pound 10. Let us say that initially pound 1 is equal to $1. So hence we can say in US term it can be $10. So here now let us say that the British pound appreciates. Now the new exchange rate now becomes as pound 1 is equal to $1.50, because there is 50% appreciation in pounds. Now, what is going to be the theoretical cost because of this new exchange rate for the importer? The theoretical cost will be is going to be 1.50 into 10, that is $15. So the US importer will now have to spend $15 in order to get one razor from the UK exporter. But in the complete pass through scenario, what can happen? In complete pass through, either the consumer in USA will buy at $15, or there can be full adjustment made by the UK exporter by reducing the price. But in the incomplete pass through, which we want to study, this is incomplete pass through. So, I should write here incomplete pass through. Incomplete pass through, that is only the partial loss is going to be absorbed. So, here the UK firm might lowers its price to pound 8, and to remain competitive, or US firm reduces the profit margin. So, here what will happen is that the new price becomes dollar 12.50, and hence what is going to be the price? So, here there is one thing that the UK firm can do, and the another thing is that the US firm can do. They can reduce the price to 12.50. So, that means there is only 50% pass through. That means only 50% of the increase, which was $5, was passed to the consumer, and then how much it is passed to the consumer here? 2.50 is passed to the consumer. So, here if we see 2.50 divided by 5, this comes out to be 50%. So, 50% of it was passed to the consumer. Now, had it been that the UK firm had reduced the price, then how much the importer might have paid? The importer must have paid pound 8 into 1.50, which is $12. Fine. Finally, why does all of this actually matter? Pass through determines how much exchange rate movements feed into the real economy through three channels. The first is inflation. If pass through is high, a depreciation of a rupee quickly raises import prices, And since India imports a significant amount of, let's say, oil, electronics, and industrial inputs, this feeds directly into domestic inflation. The RBI then faces pressure to raise interest rates to contain that inflation, even though the currency movement itself may have been driven by external factors. If pass through is low, the inflationary impact of depreciation is muted. The central government has more room to keep rates unchanged. The second channel is trade volumes. If pass through is high on the import side, imported goods become significantly more expensive after a depreciation, shifting consumer demand towards domestic alternatives and reducing the import bill. This is exactly what depreciation is supposed to do in theory: improve the trade balance. But if pass through is low, import prices barely move. Consumers do not shift their behavior, and the trade balance movement does not materialize. And the third channel is competitiveness. Complete pass through on the export side means Indian exporters fully benefit from the depreciation. Their products become cheaper for foreign buyers, boosting demand for Indian exports. But with partial pass through, some of that benefit is absorbed as exporter profit rather than being passed on as a lower price to the foreign buyers, meaning the competitiveness gain is smaller than the exchange rate movement alone would suggest. Pass through is therefore not just a theoretical concept, it sits at the heart of how exchange rate policy actually transmits through the economy. And with that, we have completed today's lecture. We covered a lot of ground. In the first half, we explored four theories that explain what drives exchange rates beyond the parity framework. In the second half, we studied exchange rate pass through, how exchange rate changes transmit into prices of imported and exported goods. Thank you.